The South African economy expanded by 0.4% quarter-on-quarter in the final 3 months of last year, marking the fifth consecutive quarter of growth. The reading comes in slightly higher than what analysts had forecast, as 5 out of 10 industries registered growth. The finance sector led the gains, while manufacturing weighed on GDP. The latest print takes growth for 2025 to 1.1%, marking the highest level since 2022. Absa has delivered a solid set of full-year results, with headline earnings rising 12% to 24.7 billion rand for the year to December. Diluted headline earnings per share climbed 11%, while revenue increased 5%, supported by steady loan growth and stronger non-interest income. A standout performer was Absa's Africa Regions business, where earnings surged 51% in its retail and business banking operations, and overall regional profit jumped 25%. A dividend of 16.35 Rand per share has been declared, reflecting growth of 12%. Looking ahead, Absa expects mid-single-digit revenue growth in 2026, though it's warned that global geopolitical tensions and potential energy price shocks could weigh on inflation, interest rates and the rand. Hyprop has reported robust interim results. In the 6 months to December, distributable income per share rose 5.4%, and that's despite additional shares in issue. An interim payout of 1.19 Rand has been declared. That's an increase of close to 5% on the previous period's dividend. Trading across the group's retail portfolio improved, with tenant turnover up in both South Africa and Eastern Europe, and vacancies in the South African portfolio narrowing to just over 3%. The property group says it remains on track to meet the upper end of its full-year guidance for distributable income growth of between 10 and 12%. Fintech is now Weaver Fintech's core profit engine. That's according to the firm's CEO, Sean Wibberley. He added that 93% of group profits now come from that division. The commentary comes alongside the release of the firm's full-year results. Headline earnings per share jumped 40%, and the group's dividend has been raised by a similar margin to 2.72 Rand. The company, which also owns retailer Home Choice, says future capital allocation will be focused on expanding its fintech platform, targeting returns on equity of around 30%. Trelidor has reported a dramatic drop in interim earnings. Now, that's after a sharp decline in revenue during the 6 months to December. Headline earnings per share plunged by more than 98% to just 0.6 cents, while total revenue fell 47% to 161 million rand. The group says the decline was largely due to the completion of a significant once-off project in the UK last year, which contributed about 38 million rand in revenue in the prior period, but did not repeat this year. Revenue in South Africa and the rest of Africa also performed below expectations, adding further pressure to the group's top line. Despite the weaker performance, Trelidor reduced net debt to 46.7 million rand and cut its interest costs. But the board has opted not to declare an interim dividend while it works to stabilize revenue and margins. Now, the rand could come under significant pressure if the conflict between the US, Israel and Iran continues for several months. According to modelling by EY Parthenon, the local unit could weaken to as much as 17.63 Rand to the dollar if the war drags on for 6 months or longer. The firms also warned that a prolonged conflict could shave as much as 40 billion rand off South Africa's economy, as higher oil prices push up fertilizer and transport costs and add pressure to food inflation. Now, ATAC has upgraded its full-year earnings outlook. That's after reporting stronger interim results driven by solid property income and high occupancy levels. Distributable income per share rose nearly 10% during the 6 months to December, while the interim dividend increased just over 9% to 48 cents per share. The group says occupancy across its portfolio remained strong at almost 94%, with rent collections slightly above 100%. Given this, ATAC has lifted its full-year guidance and expects distributable income per share growth of between 11 and 14%, while maintaining a dividend payout ratio of 80%.